Okay, Twitter. Who's got a position in Twitter? Raise your hand. I'm raising my hand. I have a position in Twitter. I am long stock, and I'm long calls in Twitter. Ooh, yes, 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 yes. 1, 2, 3, 4, 5, 6 of us. Anybody else have a position in Twitter? Yes. 7. Yes. 8. Okay, let me explain why I have a position in Twitter. The reason I have a position in Twitter has nothing to do with the chart. I'm just going to talk about it, but with the chart up. So the reason I love Twitter, guys, is Twitter is coming out with something called Twitter Voice. And I personally think that it's going to change the platform. So what's happening is right now, Twitter, you can tweet, 148 characters or whatever that number is, and now it's double, 280 or whatever, right around there. And that's how people communicate. And it's obviously a widely followed platform. What they're coming out with is Twitter Voice. And instead of having 240 characters that you could type, you're going to be able to have 240 minutes, I think, or maybe 140 seconds, excuse me, not 240 minutes, seconds. So you'll have like 2 minutes to send out or tweet whatever message that you want. There was a study that in my research of Twitter that I was reading, and this study said that 56% of shared content that's shared by writing misreads the tone, where people can't like interpret sarcasm enough through writing. And when they did the same thing through voice, it was like 78% were able to tell exactly, was this person kidding? What, just have a much better feel for the content that was being shared. So I personally think this is a big shift or game changer in an already established platform. And that's why I am super, super, super bullish Twitter, and I'm more bullish longer term. I own the stock. I also own options, but I'm really going to do well owning the stock because in 3 years, I think it trades like over 100. I think Twitter is going to finally find its legs with this new voice. Okay. I can honestly, like, just as a side before I get into the options, once I started this company since 2016, I could see it too when people email me. And speaking to a global audience, it's tough because people email me and everybody's a different quality of writer. So it's very, very difficult to control one's tone when they're writing. Like if I write something to all of you guys, to control my tone and to let you know when I'm emphatic about something and let you know when I'm kind of being a little sarcastic and when we're being lighthearted, like that's a writing skill. That's not something that most people have. So a problem that people are having with Twitter, and of course with all the fake news and bullshit or whatever, is people just don't know what's the truth and what's not. So especially in this time, it's something that I've been waiting for a while. I'm really, really excited. And that's why I'm bullish Twitter. And so I thought it'd be fun to go over the Twitter options chain just because it's a name that I enjoy staring at. And that's about it. So let's start going over. Let's do this by me asking you guys questions to see where you're at. Okay? And once we do that, that'll give me an idea of the lessons. So Twitter, last trade 30.82. Okay, 30.82. You don't have to say 32.82.5, it's just 30.82. The at the money is going to be the 31s. Okay, at the money. Out of the money, and then out of the money. And then here is in the money, and here is in the money. Okay, everyone good up to now, right? Now, if I want to look at the movement for Twitter, the first thing that I'm going to do is I'm going to value the straddle. And so when you value the straddle, you want to do at the money. And at the money is 31, like we just discussed, right? So at the money is going to be here and here. If I want to buy the straddle, I buy the calls, buy 31 calls for 260, and then 31 puts, buy. And let's buy them for 275. And so it's going to be 535. I'm buying the straddle. You could buy the straddle or you could sell the straddle, right? There's two sides of the coin. Now, for the person who buys the straddle, and that first question is coming up, for the person who buys the straddle, what do they want? What are they looking for? What is the perfect situation for the person who buys the straddle? Movement. Movement. Okay, good. Good, good, good. Okay, doing good. So the movement is going to be 535 down. So let's call it $5 just because it's easier. So the edge of the straddle is going to be 5 lower and then 5 higher. Okay, so the person who buys the straddle, you want movement. The person who sells the straddle, you want sleepiness, Z's. You want the market to close. You want the market to go to sleep for 51 days because then you collect all that premium. Okay? Everyone okay so far? Good, good, good? Good, good, good. Okay, so when volatility increases, all that really means, guys, is the straddle. So instead of the blue line, maybe the straddle moves all the way up here. And it moves all the way up there because there's more uncertainty. In a low volatile time, maybe it just messes around between 27 and 35, right? Up, down, up, down, up, down. But with more uncertainty, volatility increases. So therefore, the straddle increases. That's all it is. So always value the straddle to see how much movement there is. And you can see right here, that pretty much just gives you a little estimate of the straddle, right? We're 535, that's 570. You could also do the strangle. And the strangle is, instead of doing 31s, the strangle would tell us, hey, the stock's at 3082. The stock's at 3082, so we buy the 31s and buy the 30s. And that's doing a strangle. The benefit of doing a strangle rather than a straddle is both sides are out of the money. When you're doing options, you really want to focus on out of the money. And so just so I can see who understands that, if we look at the 28 calls, if we value at 430, how much is in the money and how much is out of the money? So 28 calls are 430. What's in the money, what's out of the money? Lots of answers coming in. Awesome, guys. I really appreciate those that are participating. The way to learn this is to participate. Participate. Don't worry about Delta. Harp, we didn't say anything about Delta. I want to know what's in the money. I guess, how about this? Sorry, bad question. Tell me intrinsic, extrinsic is what I meant. 28 calls, intrinsic, extrinsic. So intrinsic is going to be 30, 82 minus 28. The calls is 282. Okay, so you just take the 28 strike, 282 is intrinsic. And extrinsic is going to be the difference, right? It's going to be the 430 minus 282. Just do it 280 just to make it easier. And that's $1.50. Cool. Brian, great question. I'll get to that in a second. This is absolutely 1,000% required knowledge to trade options. You need to understand intrinsic and extrinsic. Okay. Now, if I go way down to the 20 strike, I'm going to keep going over these examples and stuff like this, okay? Now, if I go, let's look at the 20 strike, guys. And if we look at the 20 strike, we have 51 days until expiration. And the 20 strike is trading, let's call it 11. Okay, let's call it 11. Okay, so right away we know 20 plus 11 equals 31. So how much extrinsic is in that option? How much extrinsic is in the 20 strike calls? Ray, good. Ben, good. Good. Excellent. Everyone okay? If you're not, say, I'm like, Jonathan, I have no clue what you're talking about. Straightforward. Stop me if you need. Okay. How did you come up with the correct answer, which was 31 minus the price of the stock? Minus 30, 82 equals 18, right? How do you come up with it? You could just do 31 minus the price of the stock. David, what is that? I don't understand your comment. Why is the put 0? Ray, it's easier to learn. I don't want the computer doing the work for us. I want you to learn. So the way that you can figure this out, the other way, is look at the puts. You see the puts, guys? The puts are going to tell you what the extrinsic is in the options. What's the extrinsic on the 29 strikes? Here you go, $1.85. So whenever you want to know how much premium is in an option, if you're looking at calls, go to the put side. So if you want to know how much premium is in any of these strikes, the 27s, well, there's $1.15 a premium. The rest of it is going to be stock. So if somebody buys the 20 strike calls for $11, all you're doing is buying stock. It's the same exact thing. Same exact thing as just buying stock. Now, another useful tool that you guys could use and I think you should, is use delta. So wouldn't it make sense to buy more intrinsic? Well, Ray, no. If you want to buy stock. So if I want to buy, how about this? Let's do this exercise. So if we want to buy 1,000 shares, it's 31 grand, right? 31,000 buying power. Well, if you want to buy 1,000 shares, you know what you could also do? If you think Twitter is going higher, what happens if you buy 34 strike calls for $1.45? Once Twitter gets over 34 at expiration, you're going to be long 1,000 shares. So you can use options to kind of sneak into a position, back your way into a position. The reason I underline delta is because the easiest way to use delta is the probability of a strike being in the money. So the probability of the 20 strike being in the money is 96%. Or said another way, the market is valuing the probability of Twitter to be in the money at 96% on the 20 strike. Said another way, the market is saying that Twitter will be over the price of $20 with 96% probability. And that's how you could use delta. Here, it's only got a 3% chance of being over 50 by expiration. Now, can that change? Of course it changes. It's a live market. They update real time. But use delta as the probability of you being in the money or not in the money. But the other important way to use delta is if I buy 10, 31 calls, 0.53 delta, it's the same thing as being long 530 shares, because that's the intrinsic part of it. The part that's not, where's the other 470? That's extrinsic, that's not real. We don't have 1,000 shares yet. It's got a 53% chance of being in the money. So we have 530 shares. If we go out here and buy the 37s, if we buy a 10 lot, 2,600 bucks, 810. These are so much cheaper because it's got half the probability to be in the money. You're buying the right to own 1,000 shares. If you want to buy the right to own 1,000 shares at 20, well, you're going to have to pay full freight, right? It's already trading above there. If you want to pay for the right to be long 1,000 shares at 43, no problem, 240 bucks, no big deal. Take your shot. But you're paying for the right to be long 1,000 shares. Talk to me. Questions, guys? I'm going to segue over to Scalping Gamma right now, so I want you to stop and ask questions if you have.